Market timing feels like skill, but statistics say otherwise. When a manager raises exposure before a big move, it often looks like genius. In reality, it is usually luck, amplified by survivorship bias and fat tails. The real edge lies in managing risk exposure, not in predicting the next turn. Consider a fund manager who raises equity exposure just before a market rally. Ex post, it looks like brilliant timing. But statistically, such coincidences happen all the time. The human brain loves patterns, so we attribute skill to what is often random. The key is to separate skill from luck by looking at the frequency and consistency of such calls across many managers and many periods. To test whether timing is skill or luck, we can model the probability of a manager being right by chance. Suppose the market goes up in a given period with probability P. If a manager makes an independent timing calls, the probability of being right K times follows the binomial distribution. This gives us a baseline for what luck alone can achieve. Survivorship bias is the silent killer of timing myths. When we look at successful funds, we only see the ones that survived. The failed funds, often those with aggressive timing strategies, disappear from the record. This makes the average performance of visible funds look better than reality, and it inflates the apparent skill of timers. To correct for survivorship bias, we need to estimate the true average return. If we observe the average return of surviving funds, R_survivors, and the average return of all funds including failures, R_all, the bias is the difference. This bias can be substantial, especially in volatile markets where many funds blow up. Market returns are not normally distributed, they have fat tails, meaning extreme events happen more often than a bell curve predicts. This is crucial for timing. A strategy that makes small gains most of the time but occasionally suffers huge losses can look great in the short run. But those rare, extreme losses can wipe out years of gains. Timing strategies often have this profile. They are selling tail risk. To quantify tail risk, we use value at risk, or VAR. At a confidence level, VAR gives the maximum expected loss over a period. For a portfolio with daily returns, VAR at 95% confidence is the 5th percentile of the return distribution. If returns are fat-tailed, the actual loss can be much larger than VAR suggests, because the 5th percentile underestimates the extreme tail. The contrast between timing and risk management is stark. Timing tries to predict the market's direction, while risk management focuses on controlling exposure regardless of direction. Timing is about being right, risk management is about not being ruined. The latter is more robust because it doesn't rely on forecasts, which are often wrong. Volatility is not constant, it shifts between calm and turbulent regimes. The recent VIX data shows a dramatic drop of over 20% in just 1 month, illustrating how quickly the landscape can change. A timer who predicted higher volatility would have been wrong. Risk managers, however, adapt by scaling exposure to current volatility, not by forecasting it. When timing fails, the cost is not just a missed opportunity, it's a hit to the portfolio. A single wrong call can wipe out months of gains. The asymmetry is brutal. You need a 100% gain to recover from a 50% loss. This is why risk management, which caps losses, is more important than timing, which aims for gains. The mathematics of recovery is unforgiving. If a portfolio loses a fraction L of its value, the gain G needed to return to the original level is L divided by 1 minus L. A 10% loss needs an 11% gain, but a 50% loss needs a 100% gain. This asymmetry is why avoiding big losses is paramount. Instead of chasing timing, quant strategies focus on key metrics. These include the Sharpe ratio, which measures return per unit of risk, the maximum drawdown, which shows the worst peak-to-trough decline, and the current volatility level, which drives position sizing. These numbers are updated daily and guide exposure decisions. Market timing is a seductive illusion, but the evidence is clear. It is mostly luck. Survivorship bias and fat tails make timing look better than it is, and the cost of being wrong is enormous. The best quant strategies do not try to predict the market, they manage risk exposure with disciplined rules. They size positions based on volatility, cap losses, and diversify broadly. That is the real edge. We break down complex market ideas with evidence and rigor every week. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.